Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings Monthly Conference Call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question and answer session, at which time instructions will be provided. For operator assistance during the call, please press star 0. I would now like to turn the meeting over to Nick Hamilton. Please go ahead, Mr. Hamilton.
Great, thanks, operator. Hi, everybody. Welcome to the beginning of summer. Finally have some weather to enjoy, and we appreciate your taking the time on the call with us to get updated. I know our last call was not too long ago, but we always seem to have something to talk about, so we're happy to provide some views. So joining me, as always, is David Burrows, our President and Chief Investment Strategist, and we're going to refresh you on a few things, but ultimately what I think we're going to focus on today is highlighting how through our general preference of being a flexible asset manager that we continue to be very equity focused across our strategies, and this was a message that really began over 2 years ago as we saw markets becoming increasingly constructive and indicating what we thought was a very favorable framework for straight equities. So we continue to do that and provide that type of focus through any number of our strategies, whether that be tactical income strategy that can be 100% equities, and its focus now is dividend growers, whether that's through our straight equity strategy, our balanced, or even some of our more directional mandates that can utilize shorting as well. So we continue to focus there, and in addition, really focus on stability. So when we look at the framework for how the year has unfolded so far and year-to-date returns for the indices, you have the TSX now that's flat, basically on the year, and the S&P 500 up just a bit in so far year-to-date. When you look at the Barometer mandates, results have been really good on things that have the ability to have open architecture and focus on straight equities. So we would have at the top of our list our long-short mandate that's up the better part of 15% on the year, net of fees. Our straight equity fund, Disciplined Leadership Equity Fund, by the end of the day will be at about 13.5%. So that's constructive. Our global macro pool will be up about 11% at the end of today, and so on. As we go down to our tactical income strategy, largely flat on the year, maybe up just a snip, and that's in a backdrop where that has been quite challenging for income-producing assets. So that gives you a picture of performance, but to provide more context, I'll turn it over to Dave.
Great. Thanks everybody for taking the time. Just to review, we've made a case since late 2012 that the behavior of this market is very similar to what has happened in previous secular bull markets. And two things happen in a secular bull market that are obvious. One is that earnings grow, and second, the multiple of earnings that investors are prepared to pay grows. And between getting expanding multiples and growing earnings, you get a significant lift in price. And we exceeded the previous highs from the 1990s bull market at the end of 2012, and since then we've seen both of those things happening, expanding multiples and growing earnings. A couple of other things happen in secular bull markets, and one of the important points is that correlations stock to stock or sector to sector tend to come down, as whatever it is that is changing makes it clear there are some clear winners and there are some clear losers. So in the 90s it was tech and consumer and healthcare were the haves, and the have-nots were old economy and interest rate sensitive securities. And really, we've made the case for some time that the first part of this bull market, which we believe is being driven by the boom in energy production in the U.S., the beneficiaries at the beginning, at a time when there was more demand than supply, were the producers and the service companies and the infrastructure companies. And last summer, there was a significant gear change as supply met demand, and we went from a world where things that benefited from a high oil price made an exit from leadership to sectors that benefited from a low oil price and the leadership that emerged was consumer, healthcare, technology, and financials. Now, the fourth thing that tends to be the case in a secular bull market is that leadership persists. It lasts for a long time. And that makes it hard for investors for two reasons. One, because people love to take profits. And the second thing is, when corrections come, they tend to be more time-related than price-related. So things go to sleep. And, they often say, don't short a dull market. If I look at what happened, we came through the back half of last year with very clear leadership. We entered 2015. Leadership groups continued to behave well, although there was some component of the investment population that wanted to go back and take a look at interest rate proxies because they hadn't done well through 2014. And so for the first little while in 2015, bonds and preferreds and REITs had a bit of a lift. And we got the question, should you be rotating back towards interest rate proxies? And our premise was, well, this looks like more like a retracement than something that is sustainable. And we avoided it. Now, it cost us a little bit in the first part of the year. But as of today, virtually all of those groups are trading at relative strength lows for the year, whether you look at long-term treasuries, whether you look at REITs, whether you look at utilities, relative strength lows versus the S&P. Later on in the year, there was a group of folks who thought that maybe energy should be ready for a big bounce after the sell-off. And we certainly got lots of questions about the fact that we had no energy left in the portfolio. And for 2 months, there was a lift. As of today, energy producers, service companies, and infrastructure hit new relative strength lows versus the S&P. So those are short-lived retracement rallies. Now, the four key groups that we've been focused in across all of our mandates, just to repeat, consumer discretionary, technology, healthcare, and financials. From the period April until really early part of July, all four of these groups went to sleep and basically traded sideways for a little over 3 months. And again, we got the question, is leadership changing? Should you be rotating to something else? This is getting kind of boring. And the case that we've made in each of the last 2 conference calls is that don't confuse consolidation with a reversal in fortune. In the 1990s, they go back to the period where tech led, and it would go quiet for a period of time. People said, oh, they're too expensive. We're going to sell them because there's got to be something else to do. And then, boom, they'd take off again, and people would be left wondering and then chasing. So in the last 4 days, against the backdrop of weakness in things like commodities and interest rate proxies, consumer discretionary, many of the components have gone on to make relative strength new highs and absolute price new highs. Internet retailers, retail itself, travel and leisure, all of them new highs. In healthcare, biotech, pharmaceutical, healthcare services, all relative strength new highs, new absolute price highs. When you look at the technology group, security software, relative strength new highs. The media group, relative strength new highs, part of the consumer discretionary. On the financials made new highs about 3 weeks ago and have pulled back a little bit, but today and yesterday, again, turning higher again. So the 4 key leadership groups absolutely are intact. And the problem is when markets make a turn out of consolidations, it happens in a hurry. Now, we use stop losses on our positions. And we don't tend to trade away just because things have gone quiet. We stay with the positions that work so long as they work. And so fortunately, coming into the strength in the last 4 days, because things had been trading sideways, we hadn't been stopped on positions. We're virtually fully invested, and we've had the benefit of this lift. But to be clear, the leadership in this market is no different than the leadership that was in the market early in the year, late in last year, there's very clear leadership. Correlations continue to be very low, which means that the have groups are behaving one way and the have-not groups are behaving another. Is there scope for retracement rallies in groups that have been out of favor? Of course there is. That's not our game to try and trade those. We want to see in all of the securities that we own that the financial characteristics are pointing to something changing for the better and price doing what it should be doing given what we think we know. So our currency exposures largely are U.S. dollar focused. U.S. dollar consolidated over the last 3 months looks as though it's turning back higher again. Canadian dollar having consolidated and actually rallying a bit up into the 82 cent range, once again is bumping along the lows. We'll see where the rate decision goes tomorrow. Market might point to the fact that it's possible we could get a rate cut. So when we look at the portfolios, we're very comfortable where things are. Now let's talk about the models for a second. From a breadth perspective, over the last 3 months, there has been some correction. We saw some weakness in breadth in Europe, which is a market that we largely have avoided outside of some very specific positions. Breadth in Asia, of course, was very weak with what was going on in China. It continues to be weak. Breadth in Latin America was weak due to the impact of commodities. Breadth in North America has been the most resilient. But as it happens, when you have these little corrections, usually the strength is the last that gets hit. There was some weakness in breadth in the U.S. market last week, which for us means we sort of stopped making new purchases. The short-term indicators that we use in the first 3 days of last week went from neutral to very oversold. And on Thursday, 3 of our 4 short-term indicators turned up immediately from oversold territory. Now, I want to highlight the fact that when you have a market trading within a whisper of new highs, and the short-term indicators are oversold, not overbought, it means there's firepower under the surface, not just to trade back to highs, but to exceed the highs. We made the case over the last 2 months that when you have financials breaking out to new highs after trading sideways for a year, that's not a market that's about to break down. Financials are the nerve center of the market. When you look at the way the banks reacted this morning that reported earnings, they opened down a little and then slowly clawed their way higher through the day. That's the way leadership behaves. Leadership is like a cork. You pull it down underneath the surface of the water, but when you let it go, it pops right back to the surface. So I'm very confident that whether you're looking at the equity pool, which has roughly 25% financials, 23% consumer discretionary, 21% healthcare, and 19% technology, with 68% of the money in the U.S. stock market, 6% in Europe, and 26% in Canada, largely in Canadian-based multinational companies. I'm very confident that we're in the right spot. That portfolio is 100% invested. If you take a look at the global macro pool, which is essentially the purest sense of our top-down view of the world, expressed using ETFs across asset classes long-short, our exposure is virtually 100% U.S. The sector weightings are 30% in financials, largely U.S., regional, and money center banks and investment banks. 24% consumer discretionary, 20% healthcare, which would largely be biotech, pharmaceutical, and medical devices, and 13% technology. From a market cap perspective, 15% of the portfolio is in U.S. small caps, and 10% would be in U.S. mid caps. There's a small Japan component, which is about 3%, and a small Germany component, which is about 3%. So that's the long side. The short side is virtually all made up of short against gold and precious metals, commodities as a group, energy producers and service companies, and currencies, which would include Australian dollar and Japanese yen. So there's no single security business risk there. That's just neighborhoods, long, short. But all of our long exposure is equity and specifically consumer-led developed economy. The income fund. The income fund is just over 40% financials exposure. Consumer discretionary makes up 18% of the portfolio. Technology makes up 12%. Healthcare makes up 7%. All of these are more dividend-focused, but they're dividend growth-focused. I've made the case over the last 2 months the one significant shift I do believe we've seen is the direction in long-term interest rates. The TLT, or the long-term U.S. bond ETF, does look like it's made a turn. Long rates have gone from 1.65% to 2.4%. Stock market's up, by the way, in the process. All of the sector weightings that we have in the income pool today have a negative correlation to the bond market. So of the 9 periods we've seen rising rates in the U.S. since 2000, in each case, the high-income portfolio has been able to make money. As it stands today looking forward, the most negatively correlated sector in the market to interest rates is financials. It benefits from rising rates. That's by far our biggest weight. We are positioned for a rising rate environment. Consumer discretionary, technology, and healthcare all also have a negative correlation. Our small industrials weight, telecom weight, again, negative correlations. So we're very happy with the fact that the last 2 months, while interest rate proxies sold off pretty hard, and while the equity income index and the TSX sold off pretty hard, while we didn't make a lot of money early in the year, the high income fund did exactly what it's supposed to do. It was dead sideways through that correction. And we come out the other side, I believe, focused in the leading groups, and we're seeing the impact on that in the NAV in the last couple of days. So high income fund has had stability. It is set up for rising rates. I can't say that about virtually any fixed income portfolio I look at. I think there's tremendous risk in fixed income right now. We have no fixed income in this portfolio. The equity portfolios are focused in leading groups, and I think the right currency. They're fully invested. We come out with a great shot at moving forward here, well ahead of the indices on the year. And the balanced portfolio is the only portfolio we have that has a minimum fixed income component. It is at the minimum fixed income component, but the positions are very rifle shot corporate bonds, and they are performing very well. That portfolio is way ahead of benchmark and up just a little over 6% on the year. As I said in the call, actually, at the beginning of the year, everyone looks for change. Right now, there is no change. The change is that we have a market over the last 2 years that's behaving very differently than the market that preceded it for the previous 12 years. Consumer-led developed economies, specifically equities, are the beneficiary of a lower price deck for the price of energy. And the U.S., as the biggest consumer economy on the planet, probably stands to benefit the most. We aren't looking for a significant ramp-up in growth. Slow, steady growth will be just fine. We do expect to see interest rates slowly tick higher, not in a hurry, but the market appears to be able to handle that. We've seen it handle rising yields in the long end of the bond market. 25 or 50 basis points in the short end shouldn't be a big deal. There's no major excess built up in the economy. Economic data has been muted at best. It's very hard to have a recession when there's no excess built up in the economy. And here we head into some catalysts. So we've just gone through 4 weeks where the biggest buyer of equities in the market, corporate buybacks, have been out of the market. They are back in the market at the end of this week. There's roughly $1 trillion of buybacks expected between now and the end of the year. That's one source of demand. We are into earnings. We've been through the quiet period, which is the biggest period of uncertainty, and day by day we'll see S&P 500 companies report earnings. That will take out a second source of uncertainty. we have a very high likelihood that there's a deal to be done in Greece. That takes away another uncertainty. In effect, China has stepped in with QE. That's another brick in the wall that takes away uncertainty. And finally, it looks as though there may be a deal with Iran, which takes away another uncertainty. So, you have to remember, we used to say, get ready for a summer rally. And I know that the experience has not been the case in the last few years, but given the revisions lower early in the year based on weather, and given the uptick we've seen in economic data recently, I would expect that the summer actually probably is pretty constructive. So all of our short-term indicators in North America have turned up. Short-term indicators in Asia in the last 2 days have turned up. Short-term indicators in Europe in the last few days have turned up. The delta is to the upside. I know that clients are hesitant. I know there's lots of cash. I expect that we will continue to see money come from the bond market, given the fact that the June 30 numbers are probably going to surprise some people that they actually lost some money in fixed income. As a replacement for fixed income, I would look hard at the tactical income strategy, which is set to benefit from a rising rate environment. From an asset allocation perspective, I would encourage you to take a look at the equity-like strategies that we run. They're very well set up for this market, and certainly were our biggest driver of return in the 1990s in a similar world where correlations were low and leadership persisted for some period of time. So that's kind of where we are today. The big positions in the firm haven't changed. Our biggest weights would be things like Home Depot, Starbucks, Disney on the consumer side. On the on the financial side, Wells Fargo, Bank of America, Citigroup, the regional banks, KeyCorp, Silicon Valley Bank Corp. In the healthcare, we've got a basket of names in the biotech and pharmaceutical space, and in technology, the security software has been a real focus for us, and the Internet of Things. Very happy with the single security positions as well. Anyway, with that, I'll pass it back to Nick.
Great, thanks, Dave. So that's a picture of where we stand today. We thought it was probably worth emphasizing where we're continue to be focused, where we see pervasive market leadership. And, it really does tie back to our flexibility as a manager to overweight areas that we see increasingly robust behavior from, and really to be able to shy away from major parts of the market. It's not uncommon, well, it is uncommon, I should say, from an asset manager running North American strategy to be void Canadian banks, to be void energy altogether. But those are things that, in addition to what Dave highlighted, areas that we're avoiding currently. But it really speaks to our flexibility, and really that drives a lower correlation, which at the end of the day we understand is where advisors use us, a different behavior, so that there's less redundancy in their practice.